Well, thank you so much for joining us today. It's great to see you. I wanted to start by asking a little bit about what's really driven your passion for sustainable and ESG investing during your career so far.
Thank you, Katrina. That's a great question. I first started looking after investments in this area such a long time ago that ESG wasn't really a term that most people would recognise. However, I suppose I've always considered myself to be a bit of a green capitalist and socially conscious. So when an opportunity arose very early in my career to cover what was then quite a niche area, I kind of jumped at it. I'm also very active kind of outside of the office, and I support a range of charitable and community initiatives. I'm actually currently organising a local wildlife festival, which I'm quite excited about. And I think actually, that kind of outside the office activities, which a number of my colleagues do as well, I think it gives us quite a good balance and actually gives us a different perspective than just on the the pure financial basis that we work to in the office. My main areas of interest currently are really around kind of net zero targets and some of the new policies I expect to come out of COP26 in Glasgow later this year. And obviously that greener recovery, which obviously has been talked about quite a lot at the moment. Obviously clean energy, energy efficiency, smart materials and technology, continue to dominate a lot of the headlines that we see across the market. But perhaps more interesting, I find, around the kind of consumer element is probably around food production and some of the kind of the environmental impacts there. And I think that's going to grow and grow and grow in terms of the focus across the market, particularly as we kind of go towards those net zero targets. Obviously, here in the UK, that'll be 2050. And I'm not sure a lot of Brits are quite ready for the changes to their diet and the plate that they might have to make if we're going to hit those targets.
Yes, and I mean, we've had lots of asset managers obviously clubbing together and signing up to these agreements or these pledges that they'd like to be reaching those targets. But some people have warned that could be a kind of form of greenwashing in itself, that they're all saying they're going to be doing this. How are you sort of looking at what they're signing up to? Do you think it's achievable?
Challenging, but I believe achievable. I'm part of a number of environmental networks that kind of mix academia and professionals in the industry. And I think that the mood is very much achievable, but it's going to be quite a difficult measure. We sign up to the Principles of Responsible Investment, which we see as a key area of trying to improve reporting across the industry. We're doing a lot of work around TCFD, obviously the Task Force on Climate-related Disclosures, which we believe will be quite big here in the UK in the upcoming year and beyond. And also we also just signed up for our European mandates to the Sustainable Financial Disclosure Regulations, which we see as a key way of helping to improve transparency in the market alongside the new EU taxonomy that we expect to be introduced. So there's a lot of challenges, and greenwashing is a very big issue for all of us.
Yes, I'm going to be coming on to talk a little bit about how you sort of tackle these risks during the rest of the interview. I just wanted to ask you just briefly to maybe explain the structure of your sustainable investment offering for clients, how you've gone about sort of structuring your proposition there.
Yeah, thank you. Yeah, at Tilney Smith Williamson, we offer a range of bespoke mandates, which normally includes the likes of charities. They sit alongside our kind of core sustainable models and portfolios, which I look after on a day-to-day basis. So these include our active sustainable portfolio, which turned 15 years old last year, so it's been around a long time. Our sustainable model portfolio service, which launched back in 2011. Like I said, a number of the charity accounts that we look after for clients. These portfolios are actively managed, and they are designed to kind of suit a range of risk profiles and return objectives. And we actively integrate ESG and also apply both negative and positive screens to the main portfolio range, which are, that's kind of the line in the sand that we look to draw for quite a mainstream audience in the sustainable space. We also have a stewardship and responsible investment group, which oversees a range of kind of ESG related factors, voting and engagement, and our support for the likes of the PRI and the SFDR. So that group, which I'm part of, are very busy and they've got a lot of work on their hands, and it's good that we can bring in colleagues from across the combined business to do some of that work for our clients.
And just in terms of the due diligence process that you have when selecting funds for these portfolios, maybe you can just give us an overview of some of the really key things you're looking for.
Yeah, that's a great question. Like I said, greenwashing does make a big challenge in fund selection at the moment. In terms of due diligence, we do spend a lot of time up front looking at our investments, meeting managers to ensure they do what it says on the tin, as I like to say. This includes looking at intentionality and materiality of kind of ESG and how it's used. We take it as a bit of a given that, you know, ESG is integrated these days. Obviously, a lot of asset managers want to talk about ESG, but, you know, kind of how intentional is that within the actual investment selection, selling investments as well, if they can highlight investments that they've sold as a result of, you know, poor governance, risk management, or kind of various other issues in the supply chain. Voting engagement, again, very key. So we like to look at kind of the engagement and voting records of fund managers with their underlying companies. And then likewise, we like to engage with companies as well and get a better understanding of what a company's doing and challenge some of the management teams where we can. Within the fund space, I think it's very important that we're comparing like for like. So again, we look quite closely at the underlying holdings. You know, you often hear, you know, managers refer to their level of greenness. That gives us some kind of indication of, you know, what type of managers we should be comparing with others. Benchmarks, I think, is still a big challenge for us. We don't really rely on kind of ESG benchmarks yet, but I'm sure, again, over time that will improve as part of the wider evolution in the market. But like I said, it's all about that engagement, you know, the qualitative, quantitative work with our managers, ensuring that they are focused on kind of business risks as well as price risks of the underlying companies, you know, making sure that they do vote and engage with their managements. And like I said, we expect a lot of the new disclosure regulations will improve that transparency, which for us as investors, that's going to be key to ensure that, like I said, managers are really taking this seriously and they're not just putting out a glossy marketing document to try and hit a new sales target. You know, we want managers that take this very seriously, that have got proven track records in this space and have proper investment processes to ensure that sustainability risks are managed well.
What would you say the big challenges when really assessing funds in this area? We mentioned about greenwashing, but where would you like to see fund providers really give more information or better information to help you in your decision making?
Yeah, thank you. That's a really important question, Katrina. You know, transparency is key here. You know, like I said, we want to see kind of a lot of our due diligence, a lot of the kind of work we do up front on RFPs and stuff like that. We're asking these questions around voting policies, how they engage with, you know, companies. Do they do site visits, which in a number of cases could have dealt with some of the issues. You know, if you take Boohoo's supply chain issues last year, site visits, as far as I'm concerned, looking closer at the supply chain may have helped kind of uncover those before, you know, it got to where, you know, the issues it got to. So we were asking managers a lot of those questions. I think being more upfront with that information, I think from asset managers more you know, generally, I think was something that I'd like to see improve. You know, some managers are adapting and they are starting to put a variety of policies and kind of examples on their websites, which is great. But you know, a policy on its own doesn't really mean anything unless you can see how it's been enacted. Like I said, through the investment decisions with the underlying companies. So, you know, that's going to be quite key. Yes, impact is a really, really interesting point, particularly for a fund of fund managers. And, you know, some of the figures I see quoted in the market do make me slightly cynical. I prefer kind of some of the reporting around the SDGs, United Nations SDGs. I believe case studies around that are more kind of measurable and actually, you know, again, they can highlight to clients positive impacts alongside financial returns without some of the questionable calculations that I see elsewhere. But yeah, I think asset managers can do a bit more to kind of publish their kind of calculations within the impact reporting. I know a number of groups now have kind of third-party kind of scrutiny of their impact reports before they publish them. I think that's a really good thing that you can get academia to start, you know, checking your homework, if you can describe it that way, and before you publish, I think that, you know, all things like that, and trying to increase the kind of standards that we have in place for impact reporting and for kind of ESG more generally, I think is, you know, really important. And obviously, that's something that the regulators are trying to get their teeth into right now.
And what about your reporting then to your clients in terms of the impact of their wider portfolios? What sort of work have you been doing there?
So mainly around the SDGs. So we will shortly publish our first kind of impact report for clients, a more detailed impact report. You know, I can highlight a number of examples to our clients, and I do regularly, around kind of product involvement using some of the third-party ESG data where we've got, again, some confidence in the data we're seeing. We can highlight kind of fossil fuel exposure to kind of any of the traditional sin sectors in the market, you know, around alcohol, tobacco, and we kind of do that as a, you know, forward-looking and back-testing example, just to check that, you know, we are investing where we say we will. Equally, I said, look, around the SDGs, I think we can point to a number of the SDGs and highlight our companies and our funds that we invest in that are clearly correlated to those. So one example, one of the renewable energy infrastructure funds that we invest in now generates enough power to kind of power over 1 million UK homes. We've got other positive examples such as some of our specialist social housing providers, which are helping to accommodate people with various disabilities into high quality accommodation in communities. I have a range of examples like that, which I said I think are stronger from a case study perspective than otherwise just putting a load of data out that like I said doesn't really mean much to a client unless you explain it.
Yeah. And just in terms of the range of products out there and product development, where do you sort of see the gaps at the moment? Where is it you'd like to see more products developed?
I think really in the alternatives bucket, that's always been the challenge, I think, for most kind of fund of funds and fund selectors trying to find high quality alternatives. We've just invested in our first absolute return fund in this space, which is a kind of a multi-asset, a kind of macro strategy type product. Hedge funds in general, I think, they're difficult with clients. Some clients just don't want to invest in hedge funds, and in this space in particular, they're very anti-hedge funds. So it's a challenge, and it's a conversation that I'm sure will carry on happening with clients and investors alike. Other areas I believe that need a bit more work. We've been helping to design some and seed some fixed income funds in the market, particularly in the shorter duration space. So really pleased that we were able to seed the Vontobel 24 Sustainable Short-Term Bond Fund, managed by Chris Bowie, and they've done excellent work to try and overcome some of the issues around ESG data in the fixed income space. And they've built up their own fundamental database on a bottom-up basis, which is, as far as I'm concerned, one of the best bits of ESG work I've seen in the market in recent years. And so we were very happy to seed that fund. So, where there are gaps in the market, we will help seed and design those funds with managers. But it's mainly in the alternatives buckets, and not just the whole raft of global equity funds that I've seen launched in the last couple of years. We need other alternatives to kind of build that diversified portfolio.
Yes, I think that's what we found from speaking to other selectors as part of this series, that yes, the equity side's very well covered now, and that's clearly been sort of leading the way in the product development. But yes, there's a lot of other areas if you're trying to build that multi-asset portfolio that there just isn't the variety in selection at the moment. So something else we're hearing quite a lot at as well is obviously there's been a lot of people moves in this area, and in some cases whole teams moving around, sustainable investment teams moving around. How do you sort of cope with that? And in terms of assessing, it could be a whole new team's just moved over, but you might have liked them in their old asset management house, or you might like the products. How are you sort of coping with this period of transition?
Yeah, there's a lot of demand for ESG people with strong track records, and it keeps a lot of us busy at the moment. But we always follow the manager. We're investing ultimately in the manager. We're not looking at just the fund. We always look at the management and the people that make the key decisions around investments. Thankfully, most of our funds haven't seen any changes in management teams. They're well established in their kind of the companies they work for. To give you an example, a few years ago, we followed Peter Michaelis's team that are now part of Liontrust to Liontrust, and invested in Liontrust because we believed in the management team there. As long as we've got some transparency around who's actually making the investment decisions, and ensuring that we can monitor and analyse their track record over the longer term, we'll always look quite closely at the fund managers. But looking at the actual company they work for is obviously very important to look at the resources they actually have at their disposal to take ESG very seriously and sustainable investing very seriously. So that is part of our kind of analysis. But like I said, mostly we're looking at managers that have got proven track records in their area.
And just finally, maybe you can just give us an idea of a couple of areas you think are going to be your big areas of focus for the rest of this year and going into next year, even in terms of themes or particular things you're particularly looking at in the market.
Yeah, so energy efficiency is a big theme in our portfolio. Not losing energy in the actual, in buildings and property. I think that's a big theme. We see that as a kind of a stable grower over the long term, and as part of that net zero mix. Clean energies have been on a bit of obviously a roller coaster ride over the last 12 months. We had limited exposure going into the rally last year, and subsequently haven't really experienced some of the sell-off that a number of investors have this year. That may be an area that suddenly is, is more kind of in, we can look closely at it now, given valuations have come back. We're looking at a couple of funds in that area. Environmental markets more generally, so we invest in impacts environmental markets in our fund and have done. That's been a really strong performer for us. Web sustainability, again, is another kind of more mid and small cap thematic fund that we invest in the portfolio. We believe that they'll carry on, hopefully delivering good returns for our clients. And then equally within the alternatives buckets, like I said, we do look at those closed-ended investment companies. We do look at some of the specialist REITs in the area, and we look to blend some risk there to give us some different revenue exposures in the portfolio. I think within the fixed income bucket, I think trying to remain shorter duration, I think, is kind of what we're targeting at the moment, given the outlook for kind of interest rates. So yeah, having that diversification and trying to be exposed to some of those key themes as the economy becomes more focused on sustainability and net zero targets.
Great. Well, thank you so much for sharing your views there and giving us a really good overview of what you're doing and your current thoughts. But yeah, it'd be great to catch up with you again soon. Thank you very much. Thank you.
Thank you.